So class, please write something small here. Control, we want to define what is a control. We say that the company acquiring shares from another company, depending the percentage of share, it will become the controlling company. Therefore, let's look at some of the terms that are used under group consolidation. One of the terms is control. One of the terms is control. Control is one of the control. So control. Say an investor controls an investee. An investor controls an investee. An investor controls investee when the investor is exposed. When the investor is exposed. When the investor is exposed. Let's check. What's a subsidiary? What is a subsidiary? These are terms now that you understand or you have ever heard. That an entity that is controlled by another entity. It is an entity that is controlled by another entity. Subsidiary. It is an entity controlled by another entity. Then we have the parent or a holding company. Parent or holding. Parent or holding. Can call it maybe company. Hata hapa unaweza sema ni company. Parent or holding company. Parent or holding company. An entity that controls one. An entity that controls one or more subsidiaries. An entity that controls one or more subsidiaries. Now, what's a group? A group can say a parent company and all its subsidiary. It will represent a parent company, and all its subsidiaries. Then we shall have an associate. An entity over which an investor, it is an entity over which an investor, it is an entity over which an investor has significant influence, significant influence, and which is neither, what are we saying? Which is neither a subsidiary. It is not a subsidiary, nor an interest in a joint venture. Nor an interest in a joint venture. An interest in a joint venture. Then we have we have another non-controlling interest. Non-controlling interest. So that when you get this now, NCI. of the NCI, controlling interest or NCI, these are shares of a company, of course, that do not, and this company we are talking about is a subsidiary, but they do not, they are not attributable directly or indirectly to the parent company. That means the parent company has no control over the NCI. We call it, another term for this is minority shareholder. NCI is as well known as minority shareholder. Minority shareholder. The parent company has no control over the NCI. The parent company has no control over the NCI. That is what we were saying in our last class, that if the parent company acquires 60% of shares, if the parent company acquires 60% of shares of a certain company, if, of course, the other company become a subsidiary. Now, the 40% that remain and acquired by the parent company, that is what we are calling the NCI, the NCI, the NCI. I can see a chart here. See a chart here. Sawa. We can't hear you. Aya, hakuna sauti. There is no voice. Ama ilikuwa ya kitambo hii. 45, 47. Now I hope kuna sauti. This is Maria and Celestine. Oh, imerudi saa hii. Oops. Ilikuwa imepotea. Sawa. Sorry for that. So that is our next point, that we have said that NCI, a non-controlling interest, it is the equity share in a subsidiary. Now you understand what is a subsidiary when you talk about the subsidiary. It is the equity share in a subsidiary, not attributable directly or indirectly to the parent company, NCI. Then we proceed to the next one. Sorry. The next one is business combination. And then is a minute, we just refill the pen. Business combination. So when we talk of business combination, you can say it is a transaction or other event, a transaction or other event in which an acquirer obtains control on one or more businesses. You're saying that business combination, it's a transaction or other event in which an acquirer obtains control in one or more businesses. That is found in IFRS 3, International Financial Reporting Standard 3. IFRS 3, that is where we find the business combination. So let's have the next goodwill on acquisition, goodwill on acquisition, and gain on a bargain purchase, and gain on bargain purchase, on bargain purchase, and gain on bargain purchase, gain on bargain purchase. On acquisition, bargain purchase. Now, you all understand what we mean by goodwill. Maybe someone can remind us, who do we understand when we hear of the term goodwill? What comes to our mind? What comes to our mind? Goodwill. Remember here, it's a company acquiring another company. The other company was still existing. It was on operation. All the activity were happening. So it's ongoing. We are trying to acquire some of its shares. What do we mean by goodwill? By goodwill. What do we mean by goodwill? Tunamaanisha namna gani? We talk about goodwill. Goodwill. In short, it is the reputation of the company. It is the reputation of the company. What is the reputation? Reputation is something like, for example, you have ever heard people mentioning things like, I want to go to shop to a certain supermarket. That supermarket is the best. You find that it offers the best service. That is what we are calling the reputation or the goodwill of that company. That the well-being, they are top-notch, they are edge. When you compare to the rest, what is they are competitive edge. They are competitive edge. From James, okay. How do we do? All right. Let me check where I can mute everyone. Nowadays, Zoom are changing their data every day. Oh, so now this challenge. It's very bad. But I hope everyone has muted now. You can see now my the frequency is okay. You can see the frequency is okay from my end for my mic. Everyone on your end should be muted. Are we okay now? Are we okay now? Can you hear me? You can see the frequencies are better. Esther anasema not better, but I can see from my end now it's better. The frequency is better. You know, I can see it. I just want you people to confirm whether now it's a bit better. It's a bit better. So Esther, you can once you see that you cannot be able to hear, or maybe there is a challenge with the view of a whiteboard, you can log out and then log in again, and then log in again, and then log in again. So thank you so much. We are saying that just like this, that goodwill arising on consolidation is one form of purchased goodwill. Goodwill arising on consolidation is one form of purchased goodwill. full stop. It should be capitalized. It should be capitalized. It should be capitalized in the consolidated statement of financial position. It should be capitalized in the consolidated statement of financial position and reviewed for impairment every year. That point is very, very important. If you have a highlighter, please indicate that point should be noted better. That it should be capitalized. It should be capitalized in the consolidated statement of financial position and reviewed for impairment every year. I'll show you how do we compute goodwill for our subsidiary company, because remember that when we say that it should be capital, it should be represented. It should be represented, or it should be indicated in our statement of financial position, and it should be under non-current asset. It should be under non-current asset. And the impairment element that you can see, we are being told here, the impairment element of goodwill, we are going to add it under our which item of income statement? Who can really remember this? Impairment element, tutaiongeza wapi? Which item will be affected by the impairment element? I think we said this last time. So if you really followed our discussion last time, you can really remember what we said regarding the impairment of goodwill. Impairment of goodwill. What did we say? Who can really remember what we said in regard to the impairment of goodwill? Maybe I can remind you, for the sake of time, for the interest of time, that the impairment of goodwill is added to the administration expenses. Thank you so much, Frida. Thank you so much. Therefore, if we have a question, you compute goodwill, of course, you are going to get goodwill at the date of acquisition first. Goodwill at the date of acquisition first. Then, in the additional information, examiner can give you an information telling you that there was impairment of goodwill of 25%. So, from the goodwill that you get at the date of acquisition, you get 25% from 8. You get 25% from 8, and that will be the value of the goodwill impaired. And then when you subtract that is when you get now the goodwill at the date of reporting, or at the end of the period of which you take that goodwill to the balance sheet, the statement of financial position. Are we together? As far as computation and maybe treatment of the impairment of goodwill is concerned? We together? All right. You proceed and say goodwill arising on consolidation. Goodwill arising on consolidation is the difference between the cost of an acquisition, and the value. This is very important. And B, goodwill arising on consolidation. Goodwill arising on is the difference between is the difference between the cost of acquisition, and the value of the subsidiary net asset acquired. Class, this summarizes how we compute goodwill. It summarizes how we compute goodwill. So it is the difference between the cost of acquisition. Therefore, what is the cost of acquisition? Who did we pay as a parent company? Who did we pay to the subsidiary to acquire maybe the 60%? That value, that cost of acquisition of the proportion of shares from the subsidiary, you take that cost. Then you less or you subtract the value of the subsidiary net asset acquired, the value of the subsidiary net asset acquired. Right. So, is it okay now? Right, kuwa hivyo. Baadaye. What are we saying? We are saying that we have two methods of computation of goodwill. Goodwill is a great element here. That's why you can see me concentrating on it. It's a great element, and you need to understand how we compute goodwill. And we are saying that we have two methods of computation of goodwill. One of the method is the full goodwill method. The other method is partial goodwill method. And we have said that under full goodwill method, we have an element of NCI. Already you understand that NCI stands for non-controlling interest. Full goodwill method. And partial goodwill method. Partial goodwill method. Partial goodwill method. Those are the two methods that we shall be using to compute our goodwill. And it is important for you to understand how goodwill is computed using any of the two. So class note here. You'll be given a question, a complete question. At the end there, or under the additional information, you'll be told that there was NCI. Once you see that there was a NCI, all your given information that will help you to compute the NCI, the non-controlling interest, or the value of the minority shareholder. That means automatically which method should you use to compute goodwill. Automatically, that tells you which method should you use to compute the goodwill. Which method should you use? Yes, you shall use the full goodwill method. But when you find that a question where you don't have information in regard to the NCI, or you don't have any information that you can compute NCI value, that means you shall use the other method, which is the partial goodwill method. Partial goodwill method. Partial goodwill method. Partial goodwill method. So that is very, very important for you to understand. Very, very important for you to understand. So I hope my net will not, my mic will not disappear. All right. These methods, let's look at this method. We can start with the partial goodwill method. The format, partial goodwill method, format here, partial goodwill method. So, under partial goodwill method, and have your shillings in thousands, of course, you shall be having maybe the cost, the cost of the investment, cost of the investment, cost of investment. Or purchase consideration. Wakati mwingine inaitwa purchase consideration. Just put it there. Then you less fair value of net asset acquired. And class, please note that this item under here, fair value, will be like ordinary shares. Ordinary shares, that item will be there. You'll be having something like a share premium. Of course, then you can have maybe retained earning, revaluation. You can have revaluation under that. You can have revaluation under that. You can have revaluation under that. Revaluation hapa itakuwa na revaluation hapa, and since we are subtracting them, you add them here, then you subtract, you get the goodwill, you get your goodwill here. Is it visible? Yes, it's visible. It's visible. You get your goodwill. You get your goodwill. Now, class, assume you had been given information in regard to the impairment of goodwill. Maybe 25% or 30% of that it was impaired. You less it here. So you compute the impairment of goodwill here. Down here you say impairment. So that you're able to impairment of goodwill. Sasa, maybe 25%. You just check 25% of this amount, and then you get a value here. You subtract it, and then whatever that you get here, it will be the goodwill to report at the date of reporting. But class note here, if you're not given impairment, of this goodwill, this is the goodwill that we report. But once you are given the impairment, that means you have to proceed and now subtract the impairment the goodwill that you get after you get the difference, that is the goodwill that we report under the balance sheet. Now, this item here, the item of impairment, is the one that we say it should be added in our admin expense. It should be added in our admin expense. So it increases the administration expenses. It increases the administration expenses and thus reducing the profit at the end. Remember, admin expense, that is a cost that need to be subtracted. That need to be subtracted. Are we together? Are we together? Are we together? Tuko pamoja? Tuko pamoja hapo? Elewana, as far as that method is concerned. As far as that method is concerned, tuko pamoja. Nataka kuonyesha the full goodwill method now. It's almost the same, only that now we put an element of NCI, element of NCI. So full goodwill method, let's go to the other full goodwill method. Full goodwill method. This is very interesting. So under full goodwill method, the same is maintained. Purchase consideration, so shillings in thousand, of course, shillings in thousand. Alafu kwa mtihani msisahau hii sana. Usahau hiyo. Consideration. This consideration. Purchase consideration. So that is the first thing that you place here. How did you purchase the 60% of the subsidiary shares? How did you purchase it? It will be provided. Sometimes you'll be required to look at it. And then you have to add the NCI shares, or the value, the NCI, non-controlling interest shares. So that now you get the total consideration. Total consideration. Total consideration. And then after now you get the total consideration, ni kama tumefika hapa hivi sasa. You less the fair value of net asset, fair value of net asset at the date of acquisition. I want you people to note here what we are saying, that we are looking at the net asset at the date of acquisition. This is very important. At the date of acquisition, the date at which we acquired the subsidiary, the date at which we acquired the subsidiary is very, very important, and the items we are taking them as at that date. So the item are ordinary shares, retained earnings, we shall be having revaluation, and so on and so forth, and so on and so forth. And then remember, now we are subtracting this. We are subtracting this. But now there's something that we should be recording here. We can put it in this order. This one, this item here. How much will we be taking as a parent? We shall be having a certain percentage. For example, we acquire 60%. So tutachukua 60% ya hii. 60% of this amount, and that is what we shall subtract here. Subtract. Hiyo hatuta account, so that our goodwill will be that goodwill. So tufanya illustration itakuwa muhimu sana na tutakuwa tunaelewa. So the goodwill will be that way. If there will be impairment, you proceed now at this end. If there will be impairment, you just subtract it here, and then you get your goodwill. But if you don't have impairment, this is the goodwill that we report. That's the goodwill that we report. That's the goodwill that we report. That's the goodwill that we report. Are we together? Are we together? Are we together? So unafaa tu uelewe hivyo, si kitu ngumu, just something small. Just something small to understand. Small to understand. Small to understand. So How do we compute NCI? How do we compute NCI? NCI, let's see, computation of NCI, of which something to computation of NCI. Now that NCI umeona element inaingia hapo, wakati mwingine unakuta una, so you have to compute. So to compute NCI, you just take the NCI at fair value. I was sharing 6,000. NCI at fair value. Utakuwa umepewa at fair value. You put it to that point, then add NCI. Share of adjusted post acquisition retained earning. Ukiongeza hiyo utapata that you are getting your NCI at year end. Hiyo itakuwa umemalizana na hiyo. Utakuwa umepata your NCI at year end. At year end. Okay. I think that is it. I'll share some handouts for this, and you'd be able to look at it, because it has a lot. Okay, I think ni vizuri 6% of fair value only applies under full method. Good question from Celestine. Yes, it applies there. It applies under the full method. For the I think what to indicate something here. Let's just write something here. It's good for us to write. Consolidated, just write this. Consolidated financial statement. That is IFRS 10, and say investment in subsidiaries. Consolidated financial statement, investment in subsidiaries. Then you proceed and say IFRS 10 lays out the basic procedure. It lays out the basic procedure for preparing consolidated financial statement. That is our guiding principle under this. It lays out procedure for preparing the consolidated financial statement. statement. Proceed and say, the most important point in identifying, the most important point is identifying a subsidiary. Is identifying a subsidiary. In most cases, this is a component, or this is a company which the parent owns a majority of ordinary shares. I repeat that point. In most cases, this is a company which the parent owns a majority of ordinary shares. The company owns a majority of ordinary share. Of course, this is just like a repetition, i.e. more than 50%, i.e. more than 50%. IFRS 10 state that, IFRS 10 state that, IFRS 10, International Financial Reporting Standard 10, it states that an investor control an investee, only if has the following. Only if has the following. It controls an investee only if has the following. 1, power over investee. Power over investee. Power over investee. So you'll see that now if you have power over the company that you want to invest in or to purchase shares from, you're going to pay them something. You're going to pay them something. So there'll be some entry. There'll be an entry here. There'll be an entry. Now, bank or cash, you can pay. Bank or cash, you debit that amount. And then there'll be that now group receivable, you credit. Group receivable, you credit. In fact, we credit what goes out, right? So you credit their bank account, or maybe you give them in cash, whatever. So that means there will be that exchange transaction. For sababu, you are acquiring their shares, right? You are acquiring their shares. So what do you expect? You expect to give them something. You cannot acquire shares for free. You cannot acquire the shares for free. So there's that transaction in between. There's that transaction in between. So you can write something small in regard to unrealized profit on inventory. Unrealized profit on inventory. Unrealized profit on inventory. Unrealized profit on inventory. Just now, or maybe joining the dot what we had said last class. Unrealized profit on inventory. Or talking about ULP. So you just say between members of a group, sales between members of a group, sales between members of a group should always, sales between members of a group should always be reviewed or be viewed, should always be viewed as transfer. Sales between members of a group should always be viewed as transfer. If one group member sell goods to another during an accounting period, if one group member sells goods to another during the accounting period, the profit on the transaction, I want you to get this clearly. They are viewed as a transfer. They're just a transfer. And that's why we said, how do we treat sales? How do we treat sales or intercompany sales? How do we treat intercompany sale when it comes to consolidation? How do we treat it? As a hot air. As a hot air. Together with the intercompany debt, those are just hot air. Tunafunga macho, we just eliminate them. Yes, I'm repeating that. If one group member sell goods to another, comma, if one group member sells goods to another, comma, during an accounting period, the profit on the transaction can only be realized if the good have since been sold. I repeat that. The profit can only be realized in the transaction, can only be realized if the goods have since been sold. If the goods have since been sold to an outside party. Sold to an outside party. So that means if we have sold those goods, to realize the profit now, it is a must that the good outside party, or an outside company, a different company, outside the group. That party should be outside the group. So full stop. However, if the goods are being company, if the goods are being held by the buying company, comma, we have said, if the goods are being held by the buying company, then a provision needs to be made for unrealized profit. Sasa hapo ndio unrealized profit inakujia. Now, you remember from our illustration, the simple illustration that we had last time, we said that some of goods, a half of the goods of you will come in. An element of URP will come. Okay. So my frequency inanidanganya hapa. Okay, sawa Kezia. Sawa. So the last point, now I can see it's okay. The last point, however, if the goods are being held by the buying company, comma, then a provision needs to be made. for unrealized profit, for unrealized profit, for unrealized profit, for unrealized profit. I think we said to get our URP, I just remind you this, that unrealized profit is given by remaining intra-sales, remaining intra-sales, you multiply by the profit margin. Hiyo ndio kitu muhimu. That is the important thing that you need to understand. That formula. Next one, just say now another point. We are through with that. We go to another point. Fair value adjustment. Fair value adjustment. Fair value adjustment. Maybe this can be Roman 2, Roman 3 now. Roman 1, ilikuwa ile ya overpower. It has power. Now, under this, you say, in the calculation of goodwill, comma, the net asset of the subsidiary need to be revalued. In the calculation of the goodwill, the net asset of the subsidiary need to be revalued. Need to be revalued to their fair value. To their fair value. Need to be revalued to their fair value. Full stop. There are two ways of achieving this. There are two ways of achieving this. One, there are two ways of achieving this. One, the subsidiary company might incorporate any necessary revaluation, in its own books of account. I'm repeating the whole point. Maybe from above there, fair value adjustment, and then you check. In the calculation of goodwill, comma, the net asset of the subsidiary need to be revalued to their fair value. Need to be revalued to their fair value. Full stop. There are two ways of achieving this. One, the subsidiary company might incorporate any necessary revaluation. Na ndio maana nikawaambia kwamba when you are computing this, revaluation inakuwa included hapa. Fair value of net asset acquired at the date of acquisition. Please. You should note this. Fair value of net asset at the date of acquisition. Now revaluation ndio maana inaingia hapa. Nitawaonyesha kwa swali. When we shall be doing a question, you shall see the essence of all this. That one way, the subsidiary company might incorporate any necessary revaluation in its own books of account. Full stop. In this case, we proceed directly to consolidation. In this case, we proceed directly to consolidation, taking assets value and reserves straight from the subsidiary book. Unazichukua tu direct. Tumeambiwa kulikuwa na revaluation, unachukua ile value ya revaluation. Kwa sababu already it is converted. So if you're told that there was a plant revalued upward with this amount, una pick your amount ndio unaleta hapa in a direct form. Are you together? Na hii amount ya revaluation, remember we said inatusaidia kucalculate nini? Kuna vitu ukisha bila kufanya ile working. Revaluation amount that will be provided in no, I don't know what will happen. You should highlight. Na ndio hiyo imerudi. Sauti ndio hiyo. Ndio hiyo sasa. Accord ndio hiyo. We are asking this that revaluation inatusaidia kutafuta nini? When you find the revaluation amount. Revaluation amount itatusaidia wapi? We say it helps us to compute depreciation under charge. Do you remember that? Depreciation under charge. And the depreciation under charge value is added to our cost of sale. That you should know. That hizo ni vitu unafaa kujua tafadhali. Those are things that should be at your fingertips. Then the revaluation amount yenye iko pale we added to the PPE. So it adds the PPE value. Then we subtract PPE. That information is a golden one. Part 2. Number 2 sasa. The valuation may be made as a consolidation adjustment. Part 2. The valuation may be made as a consolidation adjustment without being incorporated in the subsidiary company's book. The valuation may be made as a consolidation adjustment. So may be made as a consolidation adjustment without being incorporated in the subsidiary company's book. In this case, we must make the following adjustment before we proceed to consolidation. What are you saying? In this case, we must make the following adjustment before proceeding to consolidation. Adjustment point 1. Evaluation adjustment. Adjustment point 2. Depreciation adjustment. Valuation adjustment, depreciation adjustment. Valuation adjustment, depreciation adjustment. So under evaluation adjustment, this one you can just write in your own words. It's not a must you follow this. The revaluation reserve created should be considered as pre-acquisition reserve. The revaluation reserve created should be considered as pre-acquisition reserve in calculating goodwill. In calculating NCI at the year end. The NCI should be credited. I'm repeating, Sarakim, that the revaluation reserve created should be considered as prerequisite or pre-acquisition reserve in calculating goodwill. Full stop. In calculating non-controlling interest or NCI, it is easier that way. In calculating NCI at the year end, the NCI should be credited. What about point number 2, depreciation adjustment? So under depreciation adjustment, this adjustment should be made in the books of subsidiary company. The adjustment should be made in the books of subsidiary company. The adjustment should be made in the books of subsidiary company from the date of acquisition to the date of consolidation. It should be made in the books of the subsidiary company. Now you understand the subsidiary company from the date of acquisition to the date of consolidation. Remember, the date of consolidation is the end date. The end date, the end, when we are closing our books. Full stop. One should first determine whether the subsidiary company has been overcharging or undercharging depreciation. Upon you first of all determine, was it overcharging or depreciation? Was it overcharging or overcharging depreciation? Depreciation. All right. I think that's okay. Okay. Profit attributable to NCI, non-controlling interest. Profit attributable to NCI. Just say something small here. The group profit after tax, should be analyzed. The group profit after tax should be analyzed between profit attributable to equity shareholders or equity holders of the parent and profit attributable to NCI. The group profit after tax, I'm repeating, the group profit after tax should be analyzed between profit attributable to equity holders of the parent, and profit attributable to NCI. Another point, another subheading, investment income. So the investment income to be reported in the group income. Investment income should be reported in the group income statement is the amount of income. I am repeating, the investment income to be reported in the group income statement. The investment income to be reported in the group income statement is the amount of income, which is outside the group. That you should note, amount of income which is outside the group. Full stop. Investment income that we report, it is any amount of income that is outside the group. Full stop. Any investment from group members, e.g., this is a great point here. Any investment from group members, e.g., dividend received by parent company from subsidiary, company should be eliminated. In fact, don't put the dividend received from the subsidiary company. We don't include them in the consolidated statement. That is also a hot air. Haiko pale, hata haweki. It should not be in the group income statement. So those are investment income like a dividend. Don't include them there. Don't include them there. So now, I showed you how to include the impairment. sawa, right? So joint arrangement. It is defined as arrangement. It is defined as arrangement under which two or more parties have joint control. Under which two or more parties have a joint control. It is under IFRS 11. It is under IFRS 11, International Financial Reporting Standard 11. International Financial Reporting Standard 11. Standard 11. Standard 11. Standard 11. Sasa, hey, I think that's all that you need to know. So that all right. Did you people write the 5 good tips down? Good. The 5 points. The 5 principles. Did we write the 5 principles? Did we write the 5 principles? Did we write down the 5 principles? Then tulisema the way we treat them. The way we treat them. The way we treat them. For example, intercompany says, "Yo muli record." Did you record down? Did you record down that treatment? So that I know where we shall start from next time. By then, this Saturday, good. If you wrote that, I think that that is the order. This Saturday, I would like us to meet. I want us at least tufanye swali ya hii topic. Sijui kama mtapatikana 5:30. 5:30. Mtapatikana? Mtapatikana 5:30. Tafadhali. I just want us to meet so that we can. This is a very conk topic. It's a very conk topic. Hapana, Kevin, sisi si watu wa jioni. Hapana. Asubuhi. Kevin Wanjara. Early in the morning, 5:30. So are we in agreement? Are we in agreement now that we are meeting on Saturday for financial reporting? Are we in agreement? All right. Yes, morning is exact. Fine. Okay, sawa. Yeah, hawa ni watu wa asubuhi kabisa. Sawa. So in the morning 5 tutapatana majaliwa tutapatana. Sawa. So if you people wrote all those 5 points, mimi naona kama tutaenda direct kwa tackling a question. But before we meet, please, can you write those points again? Andika hizo point tena. How do we treat intercompany sales? How do we treat intercompany debts? How do we treat depreciation undercharge, depreciation overcharge? How do we treat unrealized profit? Yani ukishajua hizo, who can write us a good page? Utuandikie hizo vitu zote. All the effect, all the adjustment, tuandikie tu kwa a clear page. And then piga picha, tuma kwa group. 200 kwa mwenye atakuwa wa kwanza kufanya hivyo. 200 kwa mwenye atakuwa wa kwanza. 200 ni kidogo. So write for us whatever that we had, a great summary, having everything, and then piga picha tutumie kwa group, because that is the golden. That is what you need to know. That is what you need to know. So I think that will mark the end of our today's class. That will mark the end of our today's class. And thank you so much for having time to attend this class.